As many of you know, the Jigsaw Tools now support the MultiCharts platform. In this video, I'll walk you through some of the built-in order flow tools in MultiCharts, as well as look at how the Jigsaw Tools integrate to the MultiCharts platform. It makes sense to start from longer-term analysis and then drill down to shorter-term analysis. So here's the MultiCharts main application window. In this daily chart, you can see we have a volume profile that shows the current trading range. In MultiCharts, you can set custom volume profiles to just show periods of trading you're interested in, which is really useful when the market starts to go into a range. It lets you see where most of the volume traded within that range. Next, we have the volume delta. Again, this is built into MultiCharts. This is showing what traded at the bid and offer, and we're looking right now at 10 range bars. Now, this isn't something I use myself, but it is a very popular tool for order flow traders, and it doesn't come as standard on many platforms. It's great for setting bias, but I personally prefer to use the cumulative delta to set bias. And along the bottom here is the cumulative delta showing buy market orders minus sell market orders. And again, this is built into the MultiCharts platform, and again, it's very popular with order flow traders to set bias. Now, before I carry on, I must just say that it's the MultiCharts.net versions of the platforms that Jigsaw supports. So let's just look at how we instantiate the Jigsaw Tools from MultiCharts. To run the Jigsaw Tools from MultiCharts, you simply right-click on the chart, insert study, and scroll down until you see these JT V5 indicators. So the JT V5 depth sales and depth sales live instantiates the depth and sales tool here. The JT V5 R tape instantiates the reconstructed tape here, and the JT V5 S tape instantiates the summary tape here. So let's just choose one of those. There's no parameters to enter on any of these tools. They all have their own setting screens. And here is the depth and sales tool here. As I say, all of these tools have their own setting screens. So when you want to change the parameters, how this works, then just click this spanner icon in the tools. Note also, there's a chat icon that opens up the Jigsaw chat room. So at any time, if you want to ask a question or if you want to talk to some other traders that are using the tools, you can just click the chat icon there. So that's basically how you run the tools. Now let's have a look at who uses the tools and what the benefits are. Many of you will be wondering if Jigsaw suits the way you trade. So in terms of trade styles, we do have a good proportion of scalpers, those that trade without charts, who trade frequently throughout the day for small targets with very small stops. Most of our customers, though, are longer term day traders, looking to stay in positions to take a large proportion of the daily range, often staying in trades for hours. They use the tools to refine their entries or reject trades when they see order flow is clearly against them. Now, the majority of our customers are trading futures markets, mostly because they are the most transparent markets. There are no dark pools in the futures markets, so it's a more level playing ground. We do have stock traders though, but they tend to stick to NASDAQ stocks with decent volume, say 500,000 shares or more a day, and below $80 a share, because at that point the spreads are narrower and that makes it an easier read. A smaller proportion of our customers are trading cash forex. Now, as many of you will know, there is no market depth or time and sales for cash forex. But what many traders do is watch the order flow on the forex futures and then trade the cash forex markets. 30% of our customers are full-time traders. About 10% are trading in a professional environment, including a couple of hedge funds. 20% are ex-prop traders now trading their own accounts at home, where they have more control over which platforms they can use. The majority of our customers are at-home retail traders with no professional trading experience, and most of them come to us with many years of experience but 0 years of profit. They have a good understanding of what doesn't work, they go through our educational material, see that it makes sense, and then sign up. What I'd like to do now is run through the key benefits of using the tools. First, we'll look at momentum. This really should be your starting point with order flow, because if you can recognize when a market has momentum, you will stop trying to trade against it, which means less losing trades. We'll then look at the pace of the market, how it flows up and down or ticks up and down, and the apparent ease with which it does that one side or the other side. We'll look at bidders and offers absorbing buying and selling, and how they try to cover their tracks when they do that, and how we can clearly see when they're trying to hide how much size they're willing to buy or sell. We'll then look at how order flow can be used to manage your trades, especially the early parts of a trade. Finally, we'll look at the learning curve, how quickly you can expect to see results from adopting order flow, and the best approach to take to learn these skills quickly. It probably won't come as a great shock to discover that the most important aspect of order flow is the flow of orders and their impact on price. And what we pay attention to most is what's trading right here and right now. That's what helps you confirm and reject and refine your trades. In Jigsaw, we have the current trade columns. We have sell market orders that sold to bidders on the left in red, and we have buy market orders that bought from the offers on the right in blue. We have the summary tape showing buyers here and sellers here, with a new line printed for each new price we trade at. We have power meters showing sell market orders in red and buy market orders in blue. Here showing all trades with the ability to reset at any time or when you enter a new position. And here showing trades in the past 60 seconds. And finally, showing trades in the past 3 minutes. And you can set those time periods yourself. Now, I'm not suggesting you watch all of these. Each tool will resonate with different people. We just give you the choice to mix and match. What we do advise is that you follow our instructions for getting started very closely. In terms of order flow, we're interested in the pace of moves up and down, how much size is trading on the buy side and the sell side, and what the reaction is to that buying and selling. And you can see right now the market is just chopping around with no clear direction. One of the first and easiest things you should be looking for in the order flow is momentum. And there's a few reasons that this is so important. First, if you can't recognize clear momentum, you will end up trading against it. This isn't something you'll necessarily see on a price chart. So if you enter a trade long, but there is overwhelming momentum to the downside, you will immediately be in a losing trade. Secondly, you want to know when momentum is on your side. So once you're in a trade, you can relax once a momentum move has occurred in your favor. You should exercise caution if the market is still balanced and has not shown clear momentum either way. And finally, you can join momentum moves, especially on thinner markets like crude or DAX futures, where momentum moves can be sustained over a large range of prices. So what exactly does momentum look like? Here we can see a momentum move. We see 500 contracts trade into the bid at 1983.25. And once that level breaks, we can see the market starts moving down with power. And on that move down, we can see there is much more size on the sell side than the buy side. And we can see that on the summary tape, we can see that on the strength meters, and we can see it on the reconstructed tape and on the current trades. Let's watch that again. So as well as the size, as we move down, we can also see the pace of the market. We can see how fast it moved down from the 83.25 price all the way down to 81.50. We can see very few ticks back or moves back in that momentum move down. We can also see that the bidders are getting out of the way, both here on the snapshot column showing the number of bids being pulled, and over here on the snapshot meter that shows a weakening of the buy side and a strengthening of the sell side. After the push down, we see a pause. Now that pause doesn't mean that the momentum has died. The market will often take a breather, and it's dangerous to trade against the move just because of a few seconds pause. In fact, that pause can give you a chance to re-enter the market, sometimes after the pause, and sometimes after the market does a small retrace. But you do have to be fairly fast, as the market often continues again violently after this pause. And here's a good example of what happens if you keep trading against the market just because it's put in a temporary pause because momentum faded. I meet many losing traders that build their strategy around trying to buy the low of the day or sell the high of the day, And each time the market stalls, they think it's the top or it's the bottom, and they fade that move. And in reality, what they're doing is consistently trading against the intraday trend. Many of our customers have made huge improvements in their trading just by getting out of this habit of getting on the right side of momentum and not fighting it. So momentum is absolutely the right place to start with order flow. Let's take a look at what we mean by the way the market ticks up versus ticks down and how that can help you confirm a trade. In this example, the market has moved up and now we're in a small range. And we can see that both from the chart and from the higher volume here. Now the overnight high is above us at 1981, and in terms of continuation, that's kind of a natural target. We can see that the offers above us are large, but that's normal at the top of a range, and so nothing really to get excited about. In fact, I'd say for those of you new to order flow, I would advise totally ignoring the depth and just focusing on two things, and that is the trades hitting into the bid and offer here, and occasionally glancing across at the tape here to see what the large size trading is. So what we can see right now, we have two-sided trading, no clear momentum either way. If I could just pause for a second, I'd like to explain what we're seeing here in these middle columns. It's what's trading into the bid, the sell market orders in red, and what's trading into the offer, the buy market orders in blue. And it's just showing us what's trading this time round. So what we saw, that as we moved up, 1,090 contracts traded into the offer, and we could see that this was exceptional size relative to what else had traded there. We can also see on the buy side that we have large buyers all the way up to 1979. So at the top of the range, we see that sellers have absorbed the buying and we see large buyers are trapped. So at this point, we do have a potential short trade on. We could sell 78.75 here, betting that the top of the range is holding and benefiting from those longs here getting stopped out. So if you trade up to 79.50, then you're wrong. So it's a trade with a really good risk-reward ratio, but overall momentum is to the upside, and so I think the better trade is to wait for a long signal. When I remove this from pause, we'll see a small sell-off as those trap buyers unwind, but we didn't see a huge drop because whilst those sellers did absorb the buying at 1979 and buyers were trapped, we aren't in a good selling location. We're trading against momentum, so we just get a small pop down. Now watch what happens at 1978 as we move down. This is the bottom of the range, or where the step in the volume profile is. And we can see it keeps ticking down to 1978, but simply cannot stay there or trade any decent volume there. Nobody wants to sell at that price. And this is a more subtle signal than seeing those 1,099 contracts traded above. But it is one you'll see over and over with Jigsaw. And you can see I clear the trades below 1978
Order cancelled,
just to focus on the action. And I also clear the meters just to focus on the buying and selling after that point. Now we come down to the level a second time, but again, each time it ticks down to that level, it immediately ticks back up. Somebody has standing orders there to keep buying every time the market hits that price. And this is certainly some sort of algorithm, but as you can see, it's not occurring at the speed of light. You can see it and you can react to it. Now watch this a few times and you should have a feel for what it means by the market can't hold ticks down, and it means by it seems to be ticking up easier than it's ticking down. Now, of course, we do see the market tick down to 77.75. Don't expect the market to hold to the exact tick when you see these things. But again, as we went down to 77.75, there really was no willing to sell any major amount of contracts into that price. Let's take a look at icebergs and absorption. This is where someone on the bid side absorbs selling or someone on the offer side absorbs buying. An iceberg order involves absorption, but it's when the bidder or offer hides their real intention and then slowly add more limit orders as market orders trade into their level. Now, one interesting thing about this sort of activity is that there are a number of ways you can see it, and most of them don't involve focusing on the market depth at all. It's really enough just to watch the orders and their impact on price. Let's have a look at the different components of Jigsaw Tools that can help identify this behavior. I'm not suggesting that you try to use all of them. In fact, we recommend you have a very narrow focus when first adopting the tools. What we do give you is lots of choice in how you look at the market. Different people prefer different tools, so as you adopt the Jigsaw tools, you're able to choose the tools that suit you the most. At the top here we have the summary tape. Time is on the left, and the delta, market buys minus market sells, is on the right. Then we have the bid and offer prices, and inside that we have the total amount of sell market orders that hit the bid and the total amount of buy market orders that hit the offer. Down here we have power meters that show you buy market orders in blue and sell market orders in red. The middle one is showing orders for the past 60 seconds and the bottom one showing market orders for the past 3 minutes. The meter on the right here is again showing market orders in red and blue. This time it's showing all activity for the session or since the last time you hit the R button to refresh. Below that we have the reconstructed tape. In this case showing trades of 50 contracts or more and just for the past 3 minutes so that I know when I glance across I'm just seeing the most recent activity. Then over on the depth and sales, the leftmost blue background column shows me how much has been added or taken from the bids. The inner blue background column shows me how much is currently bid, and the grey background column with the red numbers shows me how much selling has traded into that bid. So let's watch the iceberg in action.
Bid volume. Bullish divergence.
Now you may want to watch that a couple of times, each time focusing on a different aspect. But what we saw was, first, on the summary tape, we saw at 78.50 almost 1,600 contracts traded or sold into the bid, but price ticked up. We can see the meters all show overwhelming selling, but again, that's not been reflected in any move down. The tape shows a lot of large sellers sold into 78.50, but again, the result was a tick up to 78.75. The chart shows some markers to show us that both large size traded and that there was a delta divergence where more selling than buying occurred but price ticked up. We could also hear an audio alert to tell us when that happened. The depth and sales shows the richest information. We can see 1,590 contracts sold into the bid. We see 232 contracts currently bid there, and we can see that 1,246 hidden orders were added to the bid whilst we were trading there. And this is where we ended up. So let's now move on and look at another iceberg. In this case, the YH in the leftmost column of depth and sales indicates we're at yesterday's high, which is a common reversal price. We can see that as we move through that price, we get some acceleration and some large buyers from 81.50 to 82. And 81.50. A total of 1,170 contracts trade into 81.50 before it breaks. Then we move up to 1982. And we're about to see over 1,000 contracts trade. And this is a case where the order flow event occurs over a series of prices. So you may see the absorption, and it may absorb at one price, but move onwards a little, and for there to be more absorption at one of the next prices. And if you imagine in this case being a buyer and seeing it break through that 81.50 point, you would probably think that your side had won at that point, and that would give you some confidence to buy some more. But in reality, the offers were still there, waiting to catch them out. As we fast forward, we can see that the move up effectively ended as lots and lots of sellers saw that the market wasn't going to go up and jumped in onto the short side. And this is where we ended up, which brings us on to the next iceberg order. In this final case, we see the iceberg on the bid side at 76.50. What is interesting here is the follow through. These markets often give us a second chance to enter, and after the iceberg order has been executed, we can see that it comes back to that area a number of times, but it just doesn't want to trade below it. So the iceberg itself became a sort of hidden support level. Hidden because you wouldn't see this on a price chart. 76.50 wouldn't be any more relevant than any other price on the way down from a chart perspective. Now eventually we see large buyers come in, and you could wait for that to happen before you go long. You'd have more confirmation, but that would come at the cost of a poorer entry price. And there's nothing at all wrong with that. It's an acceptable payoff. And it really comes down to how risk averse you are and whether you trade the iceberg when you see it or you wait for this buyer response. And once again, this is where we got to. Let's look at how order flow can help you manage your trades. In this clip, we're close to the open after a few days of relatively low volume, and we've just popped out of this higher volume area we created just after the open. We can see buyers struggling to make any headway, so this could be a false breakout. Now before we get into the trade, we can see there's some recent trade history in the current trade columns,
Position
as well as
opened.
around 4,000 trades showing on the trade's power meter. We enter a sim trade, and when it's filled, the current trade's clear. This is done to make it easy to identify the order flow since you got filled. Now all traders can see when price moves against them, but Jigsaw users can make a distinction between price moving their way and order flow moving their way. If price moves against you, but supporting order flow is weak, there's no need to close your trade. If price moves against you and the order flow is very strong, there's no need to wait for your stop to be hit, as your trade will most likely be a loser. So far, the order flow is neutral. We've seen the market trade 2 ticks against us, but not with overwhelming buying. With reversal trades, you can wait for the momentum to start before entering, and that generally means you'll be getting in at a slightly poorer price. Just look at that as paying the price for that additional confirmation. Otherwise, even if you've seen the buyers fade away at the top, as in this case, or sellers absorbing buying at the top, you'll still need to wait for the market to really roll over and for sellers to become dominant. And that is what we can see now. We can see the meter shows sellers outnumber buyers by about 50%. We can see large traders coming in on the sell side, and we can see sellers overwhelming buyers on both current trades and the
Position
summary tape.
closed.
This is exactly what you want to see on your side when in a trade. Now if you see this against you, then that is when you need to consider cutting the trade. You may see the order flow against you like this when you are still a couple of ticks in profit. So note that you don't have to sit there and let your stop get hit. If the order flow coming in is against you and price is starting to move against you, there's a good chance your trade will fail. And like I say, you don't have to wait for your stop to get hit. You cut the trade when you can see the order flow is against you and the price is starting to move against you. Let's look at another example. In this case, we'll put a resting order at the top of the high volume area where we expect a future imbalance between buyers and sellers to occur. You can get more information on why these future imbalances occur by watching our free order flow foundation videos on the Jigsaw Trading website. Once again, we can see the meter clears, the current trades clear, and the DOM recenters, giving us a great view of order flow since we entered. In this trade, we can see the price moves against us, but there's no major imbalance in the order flow. As such, there really isn't any power to that move down. This doesn't mean we should let a trade move against us a huge amount. We still need a safety stop, but it does mean that within reasonable limits, we can allow a trade with poor order flow move against us. When looking at the order flow, the absolute numbers are important. Now, it is true that if we see 100 sells and only 10 buys, we do have 10 times as many sellers as buyers. But that amount of trade overall is insignificant. And this varies by market. If you're trading crude oil futures, then a few hundred contracts is significant. If you're trading S&P 500 futures, then you're looking for numbers in the thousands to be of any significance. So the ratio of buyers to sellers is important, but so is the total number of trades. Moving on a few minutes, we still have balanced trade. We still don't see any indication one way or another of where the market's going to go. We have 11,000 contracts traded, but we're still neutral. At this point, the trade becomes a bit more of a coin toss. There's no real reason to exit the trade based on order flow, but you do eventually get to the point where you have less reason to stay in the trade too. Moving on once more, we can see the order flow is still neutral, but price has moved up. At this point, you have to wonder how long this situation can continue with a move that has no supporting order flow. In this case, You don't have order flow on your side, but you are in profit, and it's worth considering whether you should take those profits, as this situation may not last. Moving on again, we can see that indeed the move up could not be sustained without supporting order flow. As we come back to our entry price, you can see that I manually clear the strength meter. You can also manually clear the current trades too. As we move down, we can start to see some large sellers come in, and eventually we see the imbalance is to the downside. Now obviously, we would not manage a trade like this. This example is just a sim trade done for demonstration purposes, but it does highlight the importance of recognizing when a move has no real momentum. The reason that this is important is fairly simple. If the market tries and fails to move up, then at some point the opposite side will come in and push the market down. Most professional day traders and trading algorithms are utilizing order flow. So when they see weakness in the order flow, or in this case some absorption at the top halting the move, they know there's a good probability that a push down will shake some of the long positions out. Managing your trades with order flow is actually quite simple, and it's one of the easiest skills to develop. It's really something to focus on when price is still quite close to your entry price. So for example, if you'd entered the market long on the S&P 500 futures, and you are now 4 points in profit with order flow on your side, there'll be no need to focus so intently on order flow. You can let the trade run. What you're trying to do is babysit the trade until you can see it's working and until you are clear of your entry price. The most common question we get asked at Jigsaw is, how long will it take me to learn this? And that's a natural question to ask. Now first of all, remember that this is a new skill for most people, so if you just sit down and try to trade off it the first time you use it, you will not be successful. On the other hand, don't believe that often discussed 10,000 hours to learn how to trade repeated on many trading forums. That's over 4 years full-time work. Now proprietary trading firms take people in fresh from college and teach them these skills, and many are trading live within 12 weeks. The Jigsaw approach is to set aside time to focus purely on the tools. So 1 or 2 times a day, 60 to 90 minutes at a time. And that's about as much as most people can take focusing on something really new. If you find you don't lose focus after 90 minutes, by all means carry on. Initially, you'll probably find it hard to maintain focus at some point, and at that point, just stop. After a while, reading order flow will be like riding a bike. It'll just be effortless. Now you'll see patterns recur within 6 or 7 sessions, and that won't make you an expert, but it will give you that aha moment where you go from understanding the theory you've read about on our site to your own practical experience. Within just a few weeks, you should be able to incorporate order flow into your trading to help you manage your trades. In addition, you should be able to stay out of trades where momentum is clearly against you. And the more you use it, the more use you get from it. Now we have a standing offer to all Jigsaw customers. Google our New to Jigsaw Tools video, do 7 sessions focusing just on the things in that video, then you can email or Skype us and we can have a one-on-one chat about what you're seeing and what it means. Now some people like to do this just to confirm their interpretation of what they're seeing, and some people just it's a confidence booster for them. But one thing is for certain, once you learn to read order flow, you will never trade without it again. Thank you.